Hello! In follow-up to our webinar last month, we created this short presentation to discuss a topic widely ignored in regards to the new tariffs. Therefore, the topic today is how tariffs affect your marine cargo insurance. I am Nick Esposito and I'll be your host. I wear many hats here at TRG, but one of my favorite roles is that of an educator to both my fellow coworkers and you, my audience of importers, exporters, and other international trade professionals. Joining me today is Felicia Donahue, TRG's Marine Insurance Manager. Felicia is an expert in the area of marine cargo insurance, and she works on behalf of our clients, helping them through the claims process and ensuring they are adequately covered. This presentation is put together by Risk Guaranty Brokerage Services, LLC, or as we are commonly referred to as TRG. Our direct-to-importer business model is unique to the customs bond and cargo insurance markets. We've grown our business over the last 26 years to encompass over 10,000 clients from all avenues of international trade. As an important disclaimer, the information in this presentation is for informational purposes only and is not intended and does not constitute legal advice. To keep a pulse on TRG's educational videos, I highly recommend you subscribe to our YouTube channel below. If you have any questions during the presentation, post them in the comments below. The questions will be reviewed and answered by myself or Felicia and her team of marine cargo specialists. If you would like to be a part of a community of trade professionals, join our Facebook group, International Trade Professionals-TRG. We frequently check the group for questions and encourage our members to start conversations amongst themselves if they have a common problem.
Hi, thanks, Nick. So let's get started with the primary topic we will be covering today, the effect that the new tariffs can have on your marine cargo insurance policy needs. The first issue to address here is why this topic is currently at the forefront of all of our minds. And that why is the much discussed Section 232 and Section 301 tariffs that are currently being implemented or currently under review. These tariffs currently stand as follows: 25% on steel imports into the United States and 10% on aluminum. And then there are 3 lists currently published under the Section 301 tariffs, with only 1 list currently being enforced as of July 6th. Also, in more recent news, a duty rate of 25% may be imposed on List 3 instead of the originally proposed 10%. If you want a more comprehensive look, please watch TRG's previous webinar covering these tariffs. So as you can see, it is very current news and there are still a lot of moving pieces. But the truth of the matter is that duties are on the rise and it is going to affect many aspects of international trade beyond duty. One aspect that has not really been discussed much is how these higher duty rates may affect marine cargo insurance coverage. The primary way policyholders will be affected is in the valuation process for their policy. So let's take a quick step back and define valuation as it typically works. Valuation is an estimation of the cargo's worth, which then informs the amount of coverage the policy provides. Historically, duty is not written into the valuation, although it can be written in as a specific clause on your policy. The way duty is factored into a policy is typically through a 10% uplift. The standard in the industry is for valuation to be calculated at a basis of CIF plus 10, which stands for cost, insurance, and freight. This means we would take the CIF value of the goods and then add a 10% uplift. This uplift is intended to cover incidentals that arise during the importing process, including items like duty, port fees, and broker fees. Since duty rates were typically less than 10% in the past, this 10% uplift was more than enough to cover all of the incidentals. However, this is currently changing for a very large number of businesses as a result of the Section 232 and Section 301 tariffs. With duty rates increasing up to 25% on a variety of products, the typical 10% uplift may no longer be enough to cover a policyholder's incurred duty and all of the other incidentals that can come up during a claim. It is also important to understand that these tariffs will affect both businesses importing goods into the United States and businesses exporting out to other countries. a number of countries have begun to implement their own higher tariffs in retaliation to Section 232 and Section 301 tariffs from the US. So if your marine cargo insurance policy is for shipments being exported to one of these countries, your policy may be affected as well. To help clarify how this can affect a marine cargo insurance claim, let's walk through an example of a claim for a policyholder that is subject to a new 25% tariff that has the standard 10% uplift on their policy. Before we jump into this example, we need to define a term that will be used in this example claim. That term is incurred duty. So, duty is considered incurred when the legal obligation to pay arises. Therefore, if you were bringing a shipment of goods into the United States, the duty would be considered incurred if you have already paid it, the goods have arrived at the port, and the goods have been released by customs. If you've prepaid your duties before they arrive at the port and something happens to your shipment while they're in transit, the duties are not considered incurred since the goods were never officially entered into the country. In that scenario, the prepaid duty would have to be refunded by customs and would not be eligible to be included in a claim. Alright, now let's jump into a sample situation of how these higher tariffs may affect a marine cargo insurance claim. Now, in this example, we stuck to whole numbers for the sake of simplicity. Let's take an insurance policyholder that ships a CIF value of $100,000, is subject to the new 25% tariff, has a $1,000 deductible, and has no enhancement clauses or carrier compensation to take into account. With an insurance policy written under CIF plus 10 valuation, we would have the following potential coverage on a claim. The total CIF value of $100,000 plus the 10% uplift equals $110,000. This is the agreed value of the cargo. Once you consider the $1,000 deductible, that means the policy is able to pay out a total of $109,000. Now let's consider that 25% duty rate. In this claim, we had a full loss of $100,000 of cost and freight. With a duty rate of 25%, the amount of incurred duty included in the claim is $25,000. That means that the total loss amount is $125,000. Now, as we illustrated in the previous slide, the total recoverable amount under the policy is $109,000. That means the insured is out $16,000 since the policy cannot cover any more than that. But they had a 10% uplift, so we didn't include any port fees, broker fees, or other incidentals that may accrue. So the difference between the loss amount and the total amount recoverable could potentially be much larger. Now that we've seen how the new tariffs can affect your marine cargo insurance in the event of a claim, the real question is, how can we prepare? Well, TRG is currently making a change to our coverage review process to do just that. As a proactive measure to prepare for this influx in duty rates, at TRG we are updating our procedures in order to write policies as CIF plus 10% plus duty if our customers need duty coverage. This change will enable the policies to be written to better cover those higher expenses. The trade-off of this is that it may result in a slight increase in premium since the overall value your policy is covering will also be increasing. Keep in mind that this is TRG's approach in order to be proactive. It is not a new industry standard at this time. We would ultimately recommend that you review your specific coverage needs with your policy provider, since every marine cargo insurance policy is different. Let's go back to our previous example and see the results under a policy written under CIF plus 10% plus duty. We are using the same numbers, but now we see that in addition to adding the 10% uplift, we are also adding $25,000 since that would be the amount of duty paid on a $100,000 shipment at a duty rate of 25%. So then after considering the $1,000 deductible, the total the policy is able to pay out is $134,000. Now let's see how that amount holds up on the same claim for a full shipment loss and incurred duty at 25%. The full loss is still $100,000 in cost and freight, and with a duty rate of 25%, the amount of incurred duty is included in the claim is $25,000. That means that the total loss amount is $125,000. However, in this example, the total amount recoverable is $134,000, which we saw calculated in the previous slide. Therefore, in this situation, the full amount of the loss would be recoverable with room for the incidentals like port fees and broker fees that we did not consider in the example. So you may be wondering about your policy needs. The most frequent question we get is, should I include duty in my volume estimates? Here I'm generally going to say always ask your provider to be sure, but in general, if it is listed in your basis of valuation, then yes, you should include it. Insurers expect to see an estimated volume that is commensurate to what they are agreeing to insure. If you have any questions on TRG specific policies, you're more than welcome to reach out to us. Our contact details will be provided at the end.
Thank you, Felicia. If you have any questions, please don't hesitate to reach out to Felicia directly by email at felicia.donahue@traderiskguaranty.com or via our Facebook group, International Trade Professionals-TRG. Additionally, check out our blog, www.traderiskguaranty.com/TRGpeak. It's got a treasure trove of excellent articles and information. Don't forget, you can find us on Facebook, Twitter, LinkedIn, Instagram, and most importantly, YouTube. If you like this presentation, please subscribe to our channel. Thank you.